Hi everyone! Today's topic is one of the oldest and most trusted forms of wealth building in the world, investing in land and property, also known as real estate investing. We'll discuss its background, how it works, how investors earn from it, its advantages and disadvantages, the common ways to invest, and our overall recommendation. Real estate investment refers to buying, owning, managing, renting, or selling land and property to earn income or make a profit rather than simply using it as a place to live. Real estate is one of the oldest forms of wealth. In the Philippines, owning a house and lot is often considered as a symbol of financial security. As cities continue to grow, the demand for homes, offices, and commercial spaces increases, causing property values to rise over time. Unlike a house you live in, which is mainly for personal use, an investment property is purchased to generate income through rent, resale, or bought. First, an investor buys land or property using cash or a bank loan. Properties may be residential, commercial, industrial, or undeveloped land. After purchasing the property, the investor can earn money by renting it out, developing it, or simply holding it until its value increases. Property owners also need to maintain property managed tenants if it's rented, and complete legal requirements such as verifying the land, title, and registering ownership. Finally, the investor may sell the property for a profit, continue earning rental income, or pass it on as an inheritance. Real estate provides two main sources of returns. The first is rental income, which provides regular monthly cash flow from tenants. The second is the capital appreciation, where the property's value increases over time because of growing demand and development in the surrounding area. Another advantage is leverage. Since many properties can be purchased through bank financing, investors can control a valuable asset with only a down payment. However, while this can increase profits, it can also increase losses if property values decline. Let's look at the key benefits and why each one matters. Tangible physical asset. Unlike stocks, which are essentially digital entries, land and property are physical, usable assets you can see, touch, and even live in or use directly. This gives many investors a strong sense of security compared to intangible investments. Dual income potential. As discussed, real estate can generate both ongoing rental income and long-term appreciation, offering more than one path to profit from a single asset. Natural hedge against inflation. As the cost of living rises, rental rates and property values tend to rise too, meaning real estate often maintains or increases its real value even during periods of high inflation, unlike cash sitting idle, which loses purchasing power over time. Leverage potential. As explained earlier, the ability to use bank financing means investors can control a large, appreciating asset while only putting up a fraction of its value upfront, amplifying potential returns on the actual cash invested. Scarcity of land. Land is finite resource. Developers cannot simply create more land the way a company can issue more shares or stock. This scarcity underpins real estate's long-term values, particularly in dense, high-demand urban areas. Real estate also comes with real significant downsides. High capital requirement. Compared to stock or digital bank savings, where you can start with a few hundred pesos, real estate typically requires a substantial amount of capital upfront. Even a down payment can easily run into hundreds of thousands or millions of pesos, making it inaccessible for many beginning investors. Liquidity. Real estate is not something you can quickly convert to cash. Selling a property can take months, something years, depending on market conditions, location, and how motivated the seller is. This is a stark contrast to stocks, which can be sold within seconds during market hours. Ongoing costs and responsibilities. Owning property isn't passive the way a saving account is. There are property taxes. Real property taxes paid annually to the local government. maintenance and repair costs, insurance, and if rented out, the operational burden of managing tenant vacancies and disputes. Market and location risks. Property values don't rise uniformly. A property in a declining area, one poorly located or one affected by unexpected factors, like a new noisy infrastructure project or an economic downturn concentrated in that area, can stagnate or even lose value, unlike a diversified stock portfolio that spreads risk across many companies. Leverage cuts both ways. While borrowing to invest can amplify gains, it equally amplifies losses. If property values fall or rental income dries up, the investor still owes the full loan amount to the bank, which can create serious financial strain, a risk that became painfully visible worldwide during the 2008 global financial crisis, which was triggered largely by a collapse in the US housing market. Legal and paperwork complexity. Verifying titles, paying the correct taxes, and navigating local regulations requires diligence. A flawed or fraudulent title, unfortunately not uncommon in some markets, can lead to costly legal disputes. Here are some of the most common ways people invest in real estate today. Residential rental properties. Buying condo units or houses to lease out to tenants for steady monthly income, common in cities like Metro Manila, Cebu, and Davao. Raw land banking. Purchasing undeveloped land in areas expected to grow and holding it purely for future appreciation. Commercial real estate. Office spaces, retail shops, or warehouses leased to businesses, which are often command longer lease terms and higher rental rates than residential units. Pre-selling condominium units. Buying a unit directly from a developer before construction is complete, often at a lower price, with the goal of selling or renting it out once completed and its value rise. Agricultural land. Farmland leased to farmers or used for agribusiness, offering both rental income and long-term land value appreciation. Real estate investors' trust. A more accessible stock market-based way to gain exposure to real estate without directly owning physical property. In conclusion, land and property investment is best suited for people with enough capital and a long-term investment plan. Although it requires more money and patience than other investments, it offers the benefits of tangible ownership, a steady rental income, and long-term growth in value. For investors who cannot yet afford physical property, REITs provide a more affordable way to invest in real estate.